In 2026, the U.S. economy is presented with two parallel but conflicting images. Financial news reports describe growth as stable, the labor market as robust, and the financial system as well adapted after years of monetary tightening. In reality, however, a growing segment of the American population is adjusting their lifestyles defensively, delaying spending, increasing short-term debt, and accepting lower living standards to maintain monthly payments. This contrast is no longer vague. It manifests in very concrete choices. The number of people working multiple jobs is increasing, spending on long-term needs like education, elective healthcare, and home improvements is being cut, and decisions about buying a home, having children, or moving are being postponed indefinitely. When an economy is called growing, but fundamental household decisions are frozen, the question is no longer about the percentage of growth, but about where that growth is occurring and who it is serving. Historically, periods of serious instability in the U.S. economy rarely begin with public panic. They often start with a period of false normalcy, where macroeconomic indicators remain intact, but the structures supporting real life have begun to weaken from within. 2026 exhibits many characteristics of this state. Financial markets operate at a high level, while the income-expense debt structure of the population is under increasing pressure simultaneously. What makes the current situation so sensitive is not a single shock, but a superposition of tensions, persistently high living costs, real interest rates that restrict consumption, household debt accumulated after years of reliance on credit, and fading confidence in a return to normal. When these factors coexist, the economy may still function, but society's safety margin is rapidly shrinking. The central question of this inquiry is not whether the U.S. economy will collapse in a dramatic sense, but a more difficult one: what new state is the economy shifting to, where indicators continue to function, but the resilience of individuals and communities is gradually eroding over time? Without confronting this imbalance, any assessment of stability or recovery lacks foundation. The question that needs to be asked from the outset is, what is really going on beneath the surface of the numbers that America uses to describe itself? If we only look at official reports for 2026, the U.S. economy is still described in familiar and orderly language. GDP growth remains positive. Unemployment is reported at historically low levels. Inflation, after a sharp surge at the beginning of the decade, has cooled and is considered under control. On the surface, this is an economy that has weathered the shock and is entering a period of relative stability. In this official narrative, the labor market plays a central role. Employment reports emphasize the number of new jobs created, low overall unemployment, and the service sector's ability to absorb labor. The common argument is that people are still employed, and therefore the economy is not in a severe recession. Price fluctuations are explained as a lagged consequence of the monetary cycle, gradually being absorbed as high interest rates exert their effect of curbing demand. Financial markets also served as supporting evidence for the stability narrative. Stock indices remained high, particularly driven by large-cap stocks. Global capital flows continued to view U.S. assets as a relatively safe haven amid geopolitical uncertainty and slower growth in many other regions. U.S. government bonds continued to serve as a global risk benchmark, indicating unwavering confidence in the government's solvency. Policy statements were generally cautious but reassuring. Monetary policy was described as data-dependent, ready to adjust if economic conditions changed. Fiscal policy, despite the pressure of a prolonged deficit, was defended by the argument that the size of the U.S. economy allows for higher levels of debt compared to other countries. The overarching message was that the system had learned from previous crises and possessed sufficient tools and flexibility to manage risk. In mainstream media, this picture is often presented in a way that reduces the sense of urgency. People's hardships are acknowledged, but framed within the context of short-term adjustments or the aftermath of the pandemic and global inflation. Comparisons to past deep recessions are used to reinforce the argument that the current situation is not yet alarming. This approach creates the feeling that existing problems are localized, temporary, and can be resolved over time. However, this very portrayal reflects a deliberate choice of indicators and perspective. GDP measures the total value of production, but does not reflect how that value is distributed or perceived. The total unemployment rate does not indicate the quality of employment, income stability, or the ability to keep up with the cost of living. The composite inflation index blurs the differences between spending groups, where essential items that account for a large proportion of household budgets often rise faster than average. Even financial markets, often considered the barometer of the economy, are selective. Growth in key indicators can mask deep internal divisions, where much of the increase comes from a few large companies, while many other sectors move weakly or sideways. When indicators are used as evidence of economic health, the question of their representativeness is rarely taken seriously. The surface picture, therefore, isn't necessarily wrong. It reflects what the system measures and selects to emphasize. But it is precisely the consistency and order of this picture that raises questions. If the economy is truly stable as depicted, why are more and more households adjusting to tighter budgets, and why are long-term decisions being widely delayed? The discrepancy between official language and social experience begins here, and that's where analysis needs to move beyond the surface to delve deeper. The gap between economic indicators and the experience of life doesn't form overnight. It widens gradually as the variables tracked by the system no longer align with the pressures households face daily. By 2026, this disparity will have become large enough to directly impact the living, consumption, and long-term expectations of Americans. Nominal income continues to rise in some sectors, but real income after adjusting for essential costs tells a different story. Rent, insurance, healthcare, education, and energy account for an increasingly larger share of household budgets. These are inelastic expenses that cannot be drastically cut without harming the quality of life. As these costs rise faster than wages, the feeling of an upward economy becomes alien, even for those who maintain full-time employment. This pressure is clearly reflected in the debt structure. Credit card debt and short-term consumer loans are rising not to expand consumption, but to fill monthly cash flow gaps. High interest rates turn short-term debt into a long-term burden, reducing households' resilience to minor shocks such as unexpected medical expenses or temporary income disruptions. Aggregate data may suggest the credit system is still functioning, but at the individual level, resilience is eroding. The labor market, while described as tight, reveals its limitations in real life. The number of jobs doesn't fully reflect the stability of work schedules, benefits, or the ability to sustain income in the long term. Part-time, short-term contract, and digital-based jobs are on the rise, creating the illusion of employment but not a solid financial foundation. For many households, employment no longer equates to economic security. Mass survival behaviors are beginning to emerge in small but repetitive decisions. Consumers are gravitating toward cheaper brands, delaying home maintenance, cutting back on non-emergency medical services, and limiting long-distance travel. Investments for the future, such as skill enhancement or supplemental education, are seen as risks rather than opportunities. When these behaviors occur on a large scale, they not only reflect individual hardship but also negatively impact the long-term growth of the economy. A key element of this skewness lies in how aggregate indicators blur the disparities. Means obscure differences between income groups, geographic regions, and generations. Asset-rich households benefit from capital markets that can offset rising costs, while those without financial assets face the double pressure of rising prices and interest rates. This discrepancy creates the perception that the economy is functioning for a specific group, while the rest are merely adapting to survive. It is this asymmetry that undermines trust in reassuring messages. When personal experience consistently contradicts the official narrative, people tend to rely on defensive behavior rather than expectations of recovery. They don't need an apparent crisis to change their way of life, they just need the feeling that the safety margin has narrowed sufficiently. The disconnect between statistics and reality, therefore, is not merely a matter of perception, but a signal of underlying stress within the socio-economic structure. The persistent discrepancy between economic indicators and living standards is not the result of a single statistical error. It stems from systemic mechanisms, operating over many years and only fully revealed when favorable conditions cease. By 2026, several core structures of the U.S. economy will simultaneously exert pressure on the population, even though each structure, when considered individually, could still be described as manageable. Monetary policy is an indispensable starting point. The preceding period of low interest rates reshaped economic behavior at every level. Households became accustomed to cheap credit to offset stagnating income. Businesses became accustomed to low capital costs for expansion or acquisitions rather than productivity investments. When the tightening cycle unfolds sharply and rapidly, the adjustment costs are not evenly distributed. Those most dependent on short-term credit and fixed incomes are the groups most affected early and deeply. High interest rates not only suppress demand, it exposed the fragility that had accumulated over the years. Fiscal policy contributed to maintaining a surface of stability, but at the same time increased long-term stress. Large public spending helped absorb shocks and sustain nominal growth, but pushed debt obligations higher amidst rising borrowing costs. As the budget had to allocate a larger proportion to interest and mandatory payments, the room for long-term social investment narrowed. This didn't create an immediate crisis, but it reduced the ability to improve fundamental issues like housing, education, and health care. A deeper cause lies in the structure of the labor market. The shift to a more flexible and digital model increased labor absorption capacity, but at the same time shifted risk from businesses to individuals. Volatile income, unstable benefits, and limited bargaining power meant that many workers had to bear the brunt of fluctuations that were previously dispersed within the system. As cost of living inflation persists, This structure erodes the middle class's sense of financial security more rapidly. The financialization of the economy acts as an amplifier. Profits and growth increasingly depend on asset valuations rather than improvements in real productivity. This creates a gap between the financial value-generating sector and the income-generating sector for the majority of workers. When asset markets remain high, the overall picture looks positive. But as the cost of capital rises and cash flow tightens, the pressure doesn't spread proportionally, it concentrates on the least vulnerable groups. Technology and automation, including artificial intelligence, are also a crucial structural factor. They improve efficiency at the enterprise level, but in the short and medium term create asymmetry of benefits. Increased productivity doesn't translate into increased universal income, especially when labor bargaining power is weak. Job replacement or restructuring occurs subtly, increasing feelings of instability even when aggregate employment indicators don't decline sharply. Finally, there's the issue of wealth distribution and accumulating inequality. The sharp rise in asset prices over many years has created a buffer for those who own them, while the rest face rising living costs without adequate protection. As high interest rates slow credit flows and reduce access to assets, this gap becomes more rigid. This isn't a shock, but a process of locking down opportunity. These causes don't operate independently. They interact, amplify each other, and put pressure on the same group in society. By 2026, the issue will no longer be individual policies or trends, but a synthesis of a system optimized for surface stability, but less resilient to the sustained pressures of real life. When economic pressures accumulate sufficiently at the household level, they don't remain confined to individuals. They spread to communities, small businesses, and social structures in subtle but persistent ways. By 2026, the ripple effects of economic stress in the United States will no longer be localized, they will have become a fundamental state, reshaping how economic actors interact with one another. Small businesses are among the earliest and most clearly affected. Unlike large corporations with diverse access to capital and liquidity reserves, small businesses depend directly on local purchasing power and short-term credit. As consumers tighten spending, revenue declines don't happen abruptly but are sustained, eroding their ability to stay afloat. Input costs, from rent to labor and insurance, rise faster than the ability to adjust prices. As a result, many businesses are not closing down dramatically, but rather downsizing, reducing opening hours, or delaying investment, creating a weakening that is difficult to quantify statistically in terms of bankruptcies. At the community level, this weakening accumulates into tangible changes. Local commercial areas lose diversity as only low-cost models or large chains can survive. Local jobs decline in quality, leading to labor migration or acceptance of lower incomes. As small businesses weaken, local tax revenues also come under pressure, impacting public services such as education, transportation, and community security. This is a negative feedback loop, where economic hardship reduces community capacity, and this decline in turn impacts people's lives. The middle class, which is the pillar of consumption and social stability, is also undergoing a subtle but profound change. Instead of facing a clear income shock, they must grapple with a gradual descent into higher levels of insecurity. Savings are eroded to maintain a standard of living, while the ability to rebuild assets is hampered by high capital costs. This alters their perception of risk. Decisions once considered normal, such as changing jobs, starting a business, or buying a home, are now seen as risky. As this class shifts to a defensive stance, the economy loses its internal drive for consumption and innovation. Collective economic behavior clearly reflects this spillover effect. Consumers not only spend less, but spend differently, prioritizing short-term gains, avoiding long-term commitments, and holding cash as a form of self-insurance. Businesses, observing this behavior, become increasingly cautious in hiring and investing. The interaction between the two sides creates a dynamic state of stagnation, where all actors act rationally at an individual level, but the overall result is weak growth and weakened confidence. The spillover effects also appear in the credit structure. As risks increase for small businesses and households, lenders adjust their standards to be tighter. This not only reflects caution but also reduces access to capital for those most in need of it to adapt. The contraction of credit, however gradual, slows the pace of potential recovery and prolongs economic stress. It is noteworthy that these effects are rarely identified as a crisis in the traditional sense. There is no single moment of collapse, no single shock to be blamed. Instead, there is a slow, spreading process in which each segment of society adjusts its expectations downward. It is this process that alters the economic structure in the long term, even when surface indicators still show relative stability. In most macroeconomic analyses, easily measurable and communicative factors tend to prevail. This pushes many important aspects of economic stress to the sidelines, not because they don't exist, but because they don't fit within familiar indicator frameworks. By 2026, these very invisible factors will become significant long-term risks to the socio-economic stability of the United States. One of the most clearly affected but least discussed groups is those with nominally stable employment, but whose incomes don't provide sufficient financial space. They aren't unemployed, they don't qualify for emergency assistance, but they also haven't accumulated savings. This group constantly balances essential obligations, and any minor disruption can push them into a vulnerable state. Because they don't appear in crisis statistics, their pressures are often underestimated. Another risk lies in the decline in investment for the future at the household level. As supplemental education, retraining, and preventative health care are cut, the costs don't disappear but are carried over to the future. This reduces the workforce's ability to adapt to technological and structural changes in the industry. The impact of this decline isn't immediately reflected in growth figures, but it directly affects productivity and competitiveness for years to come. Housing structures also contain overlooked risks. Cost pressures lead many households to remain in unsuitable conditions, delaying relocation due to high borrowing costs and escalating rents. This reduces the flexibility of the labor market, as workers cannot easily move to areas with better opportunities. This lack of flexibility weakens the economy's natural ability to adjust to regional shocks. At the community level, the decline in social capital is a less measured consequence. When financial pressure persists, social bonds weaken, participation in local organizations decreases, and mutual trust erodes. These factors are not reflected in GDP or unemployment rates, but they affect the community's ability to self-organize and support each other during difficult times. A society with low social capital has a narrower margin of safety against economic upheavals. Long-term risks are also downplayed in the way the financial system is assessed. Many potential vulnerabilities are masked by accounting structures, debt extensions, or expectations that economic conditions will soon improve. This doesn't create an immediate crisis, but increases the likelihood of unexpected breakdowns when expectations are no longer maintained. When these risks materialize, they often spread rapidly because they have accumulated over a long period without being definitively addressed. Finally, the long-term psychological impact on the population is often underestimated. It's not a fleeting fear, but rather a downward adjustment of expectations regarding quality of life and opportunity. As a generation grows up amidst prolonged uncertainty, their saving, investing, and economic participation behaviors shift toward greater caution. This creates a structural drag on growth that is difficult to reverse with short-term measures. These often overlooked factors don't generate sensational headlines, but they shape the long-term trajectory of the economy. When left unrecognized and unaddressed, they accumulate into systemic risks, making any future shocks likely to have a greater impact than current indicators predict. When prolonged economic pressures are not alleviated by improvements in living standards, the consequences extend beyond mere numbers or consumer behavior, reaching deeper levels, confidence and expectations. By 2026, the U.S. economy will face not only physical challenges but also a more difficult to measure form of crisis, a collective psychological crisis. Economic confidence isn't formed by isolated policy statements. It's built on the consistency between personal experience and the official narrative. When people are constantly told the economy is stabilizing, but daily life demands more effort to maintain the same level of security, skepticism gradually replaces expectations of recovery. This skepticism doesn't manifest through violent reactions, but through prolonged cautious decision-making. One clear manifestation is the tendency to procrastinate. Consumers postpone major purchases, not because of a lack of immediate affordability, but because they don't believe the future will be more favorable than the present. Businesses are delaying expansion, not because of a lack of opportunities, but because they are unsure if demand will be sustainable enough to justify the risks. When delay becomes the norm, the economy falls into a state of mutual waiting, where each entity awaits external signals before acting. The crisis of confidence is also reflected in how people perceive economic institutions. Central banks, statistical agencies, and policy institutions, once seen as stable benchmarks, are now judged through the lens of their effectiveness in real life. As the gap between policy and experience widens, trust shifts from confidence to surveillance, and from surveillance to suspicion. This is not a complete denial, but a psychological retreat from the expectation that the system will self-correct in favor of the majority. Widespread defensive sentiment alters long-term financial behavior. People prioritize liquidity over yield, accepting lower returns in exchange for a sense of security. This shift, when occurring simultaneously, diminishes the effectiveness of traditional stimulus tools. Lower interest rates do not necessarily encourage borrowing, and signals of stability do not automatically restore spending. Negative expectations, once deeply ingrained, become an independent drag on growth. The generational aspect exacerbates the problem. Those entering the workforce during prolonged periods of instability form a different frame of reference regarding risk and opportunity. For them, stability is no longer the default, and long-term decisions are tied to extreme caution. When a large generation shares the same defensive mindset, the economy faces not only a cyclical downturn, but a structural shift in behavior. It is noteworthy that a crisis of confidence does not require a single triggering event. It develops as an accumulating process, where each adjustment of expectations is small, but collectively creates a major shift in how society operates. An economy can continue to function in this state, but with lower efficiency and a thinner margin of safety. Psychological crises, therefore, are not a byproduct of economic problems, but rather an integral part of them. When confidence weakens, the system's ability to recover decreases, and any potential shock risks having an impact far beyond its initial scope. By 2026, the U.S. economic picture cannot be summarized by a definitive conclusion. Analysis suggests not a dramatic collapse, but rather a prolonged state of tension, with the fundamental structures of economic life under simultaneous pressure. It is in this context that future scenarios should be viewed as conditional developments, rather than definitive predictions. One possible scenario is that the economy maintains superficial stability while continuing its quiet adjustment. Nominal growth is sustained by public spending and sectors with good capital absorption capacity, while the lives of the majority improve slowly or not at all. In this scenario, society adapts by lowering expectations, accepting a higher level of uncertainty as the new normal. The economy does not fall into an overt crisis, but gradually loses momentum and the ability to rebound strongly. Another scenario involves the emergence of localized fault lines, where tensions build up in previously overlooked areas. Pressures in credit, housing, or local finance may surface through isolated events, forcing policy responses. These responses may help prevent contagion, but they also expose the limitations of existing tools. Confidence, already fragile, may be further tested, leading to deeper behavioral adjustments by individuals and businesses. A third scenario involves the possibility of restructuring, where current pressures force the system to adjust in a more long-term direction. This requires a clear acknowledgement of the disconnect between data and real life, along with policies aimed at addressing fundamental bottlenecks such as the cost of living, access to housing, and income security. This scenario does not promise a rapid recovery, but opens the door to more sustainable improvement if implemented consistently. The common thread in these scenarios is a high degree of uncertainty. There is no guaranteed path to a positive short-term outcome, and no indication that current tensions will simply disappear. The role of expectations and beliefs becomes central. They can amplify difficulties or support adjustment, depending on how the system responds and how society interprets those responses. The open conclusion of this investigation lies not in predicting the timing or form of a crisis, but in identifying the state the economy is entering. When surface stability no longer fully reflects internal health, the ability to accurately assess reality becomes crucial. The big question is not whether the United States will avoid a crisis, but in what direction the economy will adjust, and who will bear the costs of that process.